In our first session, we will delve into the intricacies of insurance with H.K. Henderson, Navicourt. They've gathered some of the best minds in the country to enlighten us on the implications of our industry, and it's my pleasure to give you a sneak peek into what's in store. Now, I would like to welcome Dustin Halverson back on stage to briefly introduce today's session and the panel to protect your power.
So I was just talking to Jamie out there. He goes, just have some fun. I'm like, yeah, insurance and fun. Like that's. So the fun part is we're going to bring in all of your policies and we're going to go over them front to back. Highlighters are being handed out by the team, and we're going to go through every line of coverage before you leave the room. Or what we can do is try and be engaging, try and bring you some perspectives on lines of coverage that protect your power, protect your profitability, that may not be just focusing on property and liability. We're with H.K. Henderson. We'd be one of the largest brokerages in the province, but our parent company is Navicourt. And Navicourt is one of the fastest growing, biggest commercial brokers in Canada. And what's unique about us is we really do believe in keeping the entrepreneurial spirit alive, no different than you in this room. When our M&A strategy goes, we're looking for partners to continue to grow the business and continue to wave the local flag. And with that, we're proud to say that one of the biggest coined sayings that we have is local touch, national strength. And today we are going to flex that national strength, and that's evident by being able to bring in a panel from across the country with Danielle Gorst, who is leader of directors and officers insurance across the country for our group. We've got Wes Robinson. He's one of the brightest minds in cyber risk protection and insurance in Western Canada. Why don't we just say Canada, okay? And then Mark Wyatt, who's a director at Intact Insurance. And the reason we wanted to bring Mark was because so many of you in this room have Intact coverages on your property, potentially on your liability. And we wanted to give you an opportunity to blame Mark for the cost of insurance. No, we wanted to give you the opportunity to hear how the market is viewing you and what they're looking for in the future. And ultimately, we're going to spend an hour together. We're going to try and answer some questions that you may not even known you had, uncover a couple of blind spots. Again, what I always say when I meet with my clients and prospects is let's protect your profitability first, and let's work up backwards from that. So with that, I want to thank Bob and the membership committee. I got to be invited by Donna to be a part of the AMC membership committee, and the first meeting that we had was talking about this, which would have been, 8-10 months ago. And I thought they were playing a prank on the new committee member when they said, yeah, we're having this conference, it's going to be in Regina, and I think that the crowd would like to hear about insurance. I'm like, okay, are you guys trying to bait me into acting excited right now? But no, I really appreciate the opportunity. We're very proud to be presenting sponsor, and with that, we'll jump in. So let's get the panelists ready to go. I gave a brief introduction, but ultimately, Danielle is here to help us understand about protecting your people and their personal liability. Wes on the far end is going to be about cyber, and Mark is going to be protecting your property, assets, and profitability. We want to start with directors and officers because ultimately, I think many of you in the room are hearing about it. You may have it. You may not understand exactly what's going on with it. And Danielle's being one of the best. We want to talk about what it is and why you might need it. And with so many in this room active in mergers and acquisitions, and you could be on either side of that, right? You could be trying to sell, you could be trying to buy. We're going to get into that. We've talked about ESG all the time. We're going to shed some light on how that comes back to directors and officers and employment practices. So we'll jump in. Danielle, maybe you can give your definition of D&O and what it is and when is it recommended, and at what size should our audience be thinking about purchasing this?
Sure. Thanks, Dustin. So I am a specialist in directors and officers liability. I've been practicing in this space for almost 25 years, directly out of the University of Calgary. They had actually a Bachelor of Commerce program that specialized in risk management, and when I got into this role, I had no idea what directors and officers liability was. I'd heard about insurance, property, casualty, but this was a very unique specialty space. And when someone asked me what D&O insurance, for short, directors and officers liability is, I really call it boardroom malpractice coverage. So similar to a doctor buying medicine malpractice, a board of directors and senior leadership want to make sure they're protected by a directors and officers liability policy. So if you want to just flip up the slide, Dustin. So this is just sort of a picture of directors and officers in the middle really have a higher duty of care than any other employee. We're all sort of employees of our company. If you go back to kind of Law 101, we really as an employee have vicarious liability, but directors and officers have a higher duty of care that they owe to their stakeholders. And so when we talk about directors and officers liability coverage, we're talking about personal protection, not corporate protection. So companies see litigation that comes in the door. Typically, it just names the corporation and its corporate liability, and maybe your general liability policy would respond to that. But the minute it tags an individual director and officer in that claim, it becomes personal, and that's where a D&O policy comes into play. So when you're sued personally on behalf of your company, or on behalf of being a director or an officer of your company, you expect the corporation to protect you. And generally speaking, they will indemnify you for defense and settlement. But I ask the question to my clients, what happens if that indemnification is not there because you acted dishonestly, or they just don't believe what you did was in the best interest of the corporation? Or what happens, worst case scenario, the company doesn't have any funds to indemnify? Okay, so that could be a bankruptcy situation. So those are the types of scenarios where you really are going to rely upon a D&O policy to be kind of the backstop to your corporation not being able to protect you for your personal liability.
And those go together, right? As soon as you've ran out of money, people are looking for who's responsible for why this is out of money. And without the D&O in place, I think that's what you're getting at.
It's coming out of your pocket, essentially, so you have to defend yourself. And if the corporation's not there to defend you, that's where a D&O policy comes into play. And in Canada, as the slide sort of says on the bottom, there's a lot of federal statute laws that do impose personal liabilities on directors and officers. So obviously, if you're a publicly traded company, you need to abide by securities laws. That's very obvious. Anything you represent to shareholders, any sort of misrepresentation to shareholders, as a CFO or CEO, you're signing off on those financial statements and you're making representations and news releases and whatnot, and the board's signing off on those. They incur personal liability every time that they release information to investors. You've got bankruptcy laws in Canada, and this is a big one that I think for private companies, I think companies in general don't recognize that when a company is bankrupt, the directors and officers of that company can actually be held personally responsible for any unpaid wages of employees that are outstanding, any government remittances like GST, PST taxes owing, and any vacation paid to employees. So when I advise companies that are going into the zone of insolvency or insolvency, their D&O policy and protection becomes ultimately their backstop.
And on that, you might be going, well, I'm not on the board. I'm just on the senior leadership team of my practice or my company. We don't even have a board, or maybe you are officially on the board, but defining who could be a part of this coverage or on the hook is probably worth pointing out.
Yeah, I mean, directors are obviously appointed by shareholders, and I mean, you could have a small private company where the shareholders are the directors. So it's kind of one and the same. They're the owners of the company. And then the officers are appointed by the directors. And officers of companies have, all sorts of names. I mean, it could be a CEO, CFO, COO, general counsel, risk manager, and then so forth. It could be just a senior operating manager of a division. And in general, I mean, if they are sued personally, the policies that are out there nowadays go above and beyond just defining directors and officers. They actually will include employees as co-defendants alongside any of those individuals. So very, very broad coverage if by chance that senior employee is named personally in a claim.
Okay, so we could talk about this for the full hour, but we want to move through a couple of topics. You may be in a position that you are looking to elevate your board. You are looking to take your company bigger, and you're looking to attract thought leadership to your group from outside. You could talk about elevating your board and how this could play a part.
Right,
or you
so-
might be asked to be on a board. There's a lot of great minds in this room.
Yeah, so I mean, I think maybe the question you're asking is at what size do we really need D&O insurance? And I would say every company, whether you're not for profit, so any association should buy some level of D&O insurance. I don't think you would even sit on a board, even if you were asked to sit on your child's hockey team, baseball team. I certainly wouldn't accept a position unless I was told that they had some sort of liability or association or not-for-profit liability coverage in place. Public companies, easy sell. Almost every public company buys some level of D&O insurance because it's almost a tick the box. The level of severity and risk of being sued is high. Private companies, they always ask the question, why do I need it? And I mean, at the end of the day, if you want to sort of, so this is kind of a slide that sort of depicts public and private companies and the risk of litigation. And what you'll see here is a lot of overlap between the two. You'll see bankruptcy, of course, regulatory breaches, that kind of thing. But the one I wanted to kind of point out is that for private companies, the biggest risk that we have seen over the last couple of years, particularly sort of through pandemic and post-pandemic, when a lot of companies were trying to pivot, trying to maybe bring in equity shareholders, maybe private equity was coming into play, is this risk of oppression. So in Canada, we have something called the oppression remedy, which means that if you feel like you've been personally wronged, you can file a lawsuit against a director and officer under the oppression remedy. So here's a classic case. 3 owners of a company all own a third of the company. 2 of the owners of the company decide to have a secret meeting and say, hey, we're going to go in this direction. We've decided to sell the company, or we've decided to bring in another equity stakeholder. We've decided to take on debt. Something where the third shareholder says, you've oppressed my rights within this company. So we see these types of claims all the time, and you see it in succession type of claims where family members, someone passes away, an owner passes away, and the wife or the son, they want out. They want out of the company, or they want to go in a different direction. So these types of oppression claims have been rampant, through the last couple of years. They're very costly to defend. They're probably 6 times more than an average D&O claim. And just in general, just to kind of summarize, D&O claims are not a frequency issue. So, you buy the coverage, I call it sleep coverage. You should never expect to have a D&O claim, but God forbid you did, there's severity. So the average D&O claim for a private company would be about $500,000, and that's coming directly out of your balance sheet. So the fact that D&O coverage is fairly inexpensive nowadays, if you had one claim in 10 years, it would certainly pay for itself.
Mm-hmm. Okay, so back to the M&A conversation.
Right.
That's something, when we look at what this industry's been able to do, Premier Mo spoke to it, the growth is phenomenal, and there's a lot of chips on the table for people looking at where does 1 + 1 make 5, right? And those mergers, acquisitions are a part of something you want to consider, not just from your company, but who you're buying. So maybe you can speak a little bit to that.
Yeah, so M&A, mergers and acquisition and transactions in general, so that could be private equity buying into an organization, it could be a company going public. Those create risk of D&O claims. So when you're thinking about M&A activity, it's really wise to have a D&O program in place, because M&A and integration doesn't always go well. You may buy a company, you may be letting go of employees, you may be bringing in debt holders, you may be changing the capitalization of a company. All of those things create risk. trying to buy D&O coverage for your company when you're going into a transaction is very difficult. It's very expensive. So the idea that you buy the D&O coverage when you're kind of a startup, you know, nothing's really taken place, you have some loyalty history with an insurer that takes you through the transaction, that's where you want to be. You don't want to be going into a transaction trying to get the coverage. On the, you know, the other side of things is during sort of post-pandemic, we saw a lot of private equity coming in to buy companies. Typically, to close those deals, they want D&O coverage to be in place, and they want you to run that coverage off for any exiting board members or officers of the company before they come into the door to take ownership in. So again, we had a lot of companies approach us, say, we don't have D&O insurance, but private equity wants to buy us, and now we're trying to get it. And so we had difficulty trying to find coverage when there was a transaction actually on the table.
Mm-hmm. So preparing for that planning,
for that eventual event.
Proactive education to your broker about what does your 3 to 5 year plan look like for an organization. Plans change, but what is on the table, so they can come back to you with suggestions on things to set yourself up. We could continue on with D&O, but I think we're going to move on to cyber and see where we're at. But I think when we think about cyber insurance, and actually, do you mind, maybe just a raise of a hand if you buy cyber insurance for your group. It's a lot bigger than what it used to be even 5 years ago, right? And I think that there might be trust issues around buying cyber. You go, well, what I'm going to buy so I can give the criminal money and then expect them to act ethically and move on? Is that really going to happen? So Wes Robinson joins us from Navicord office, Iridium in Calgary. Wes was just out in Toronto last week for a cyber conference, and I'm excited to pick his brain and bring a little more light to what cyber risk does, how it triggers, and how dangerous it is for you. So who needs cyber, Wes? And you know, maybe you can give a little bit of background on how cyber coverage is becoming more prominent.
Yeah, absolutely. Thanks, Dustin. Just to give a bit of background on myself, I actually also am an alumni of the same program that Danielle, and I think Mark is also in the same alumni program. So did my Bachelor of Commerce in Risk Management as well. Didn't always start out in cyber. It is an emerging coverage. So I was happy to see a few hands go up in the room that cyber coverage is on people's minds. You know, at the end of the day, it is still an emerging coverage. It's an evolving coverage to an evolving risk and to an evolving trend. I think the threat landscape that we see in the cyberspace is always evolving, and it's evolving in a lot of ways quicker than we are keeping up with it. You know, I think to the same point as Danielle on the D&O, in my opinion, who needs cyber? The answer would be everyone. You know, criminals don't really discriminate between who they attack in this space. Quite often, small to medium enterprises are the easiest ones to hit, and you can hit 1,000 of them at the same time with the same vulnerability or the same strain of ransomware that you buy off some Russian state actor. Vice versa, I mean, obviously large companies are also a target. You know, the data they hold, the money that's at stake, and the intellectual property that they also hold are valuable to a lot of these state actors, to a lot of these criminal groups. And for larger companies, they will spend the extra time and resources to get in, as opposed to kind of picking on the low-hanging fruit of other industries. I think I have a slide actually on this one. If we just
and one thing I love to point out is it's not like getting a cold. Oh, I got hacked, and they're gonna just tell you right now how long they can spend in your system forwarding emails from within your staff to themselves to then get in the position to trick your best people, and when you need it most. You know, let's face it, Black Friday week, right? So some of the retailers out there would need everything to go perfectly because this is a critical week. Do you think now is the time to cyber attack, even though you've been in their system for 12 months? Or do you want to get them on, you know, an average business day on a Tuesday morning, right? You want to hit when it hurts, and so maybe you can speak to that a little bit as well.
Yeah, I think that's a really good point. I mean, to be honest, in my personal experience, as well as in the experience of the claims providers that we work with insurers, almost 100% of these claims happen on a Sunday morning. They happen on a Friday afternoon of a long weekend. The criminals are incredibly savvy to the fact that the longer a claim goes on for, the more the costs rack up and the more critical it becomes to the business to settle and to pay the ransom potentially. So that's why they take advantage of that. They tend to hit on that Friday afternoon, so they get the full weekend of kind of chaos and disarray. But that's kind of what insurance ends up being for. Insurance providers have partnered with strategic panels and instant response firms that ultimately are there for you 24/7, 365 days a year to take that call on a Friday afternoon and work for you over the weekend in negotiating this ransom and hoping that you can either when you end up paying the ransom or you don't, that those 2 days are critical into getting your systems back up and running. I think to the point of what Danielle was talking about actually, so this is a visualization of a global survey of directors and officers, so public companies across the planet. And it's talking about what the risk trends that they really see and what is pertinent in their minds right now. And you'll see over the years here, data loss, data breach, and cyber attacks have always been kind of top 1 and 2. But in 2022, we saw cyber extortion start to get onto the radars of a lot of boards. The frequency and severity of ransomware attacks has truly been a bit of an innovation in the cyber crime space since the pandemic began. And it's not going anywhere anytime soon. So now you'll see, the top 3 out of 5 risks that the board is really concerned about are all effectively cyber risks, which, to Danielle's point, these also do lead to D&O claims sometimes when the board can be sued over not handling a cyber claim properly, not having insurance in place, not even thinking about the insurance. We see those kind of action claims sometimes, all the time, in kind of bad, poorly handled cyber lawsuits sometimes.
Yeah, perfect. What does it look like? Let's pick on Bob, the new chair. Highline gets hacked. What does that look like for Bob or his team? How does he find out? What are the ways that could go? And then what is the coverage actually doing? I think, would you guys like to hear that a little? Because we talk about it like you're already in it. But how did it happen? When does Bob find out? And what does Bob do? Without coverage, we pretty much know you don't know what to do. You start phoning every advisor you have to the group, and you start going, okay, we need who's negotiating with who can even log in? How do we talk in crypto? All this stuff, right? So how does it look, and then what does the response look like? I think Wes is maybe just a good education piece.
Yeah, so what it ends up looking like, hour 1, it ends up being kind of that screen of death, they call it a lot in the industry, especially in the case of a widespread ransomware attack. Every screen in your organization will kind of have that skull and crossbones on it, depending on the strain of ransomware that you're being hacked with or which your data has been encrypted with. And it'll effectively say, your data has been encrypted. In order to decrypt your data, go to this website, go to this chat service, chat with the criminals, and pay this ransom to get the decryption keys. Now, without insurance, as kind of a nerd for technology, I did work in website design previously, and I worked at a company that, so I've always been a bit of a nerd for tech. Without insurance, ultimately what ends up happening nowadays is that the vendors and the providers that you really want to respond and you want to negotiate with these Russian state actors, with these North Korean state actors, Iranian state actors, they're busy. They're all on insurer panels. They're very difficult to get a hold of, and if you can get a hold of them, they're going to be multiples of the cost that you would pay through an insurance policy. So you can get a hold of a Norton Rose, like a lawyer, a breach counsel, to kind of come in and negotiate with the ransomware providers, but you're going to pay multiples of what an insurer would pay because they're on the insurer panel, and the insurers keep them quite busy, so they're also not super easy to reach. So that's kind of without insurance. With insurance, ultimately, hopefully your broker is placed you with a reputable provider. There's some kind of 24-hour call line. Sometimes there's a mobile application that you can report these claims to. And, first hour, within the first 5 hours, you should be having a call with your insurer and with their panel response providers to chart out the next steps and see what you need to do next. Can you rely on your backups? Have those been encrypted as well? How do you negotiate with the criminals? What does that look like? And ultimately, if you decide to pay the ransom, I mean, how do we do that? How do we facilitate payment? How do we pass a sanctions check if you need to pay a Russian-based group? These providers do that day in and day out. That is their bread and butter. So there is a marked difference between doing this without insurance and doing this with insurance. Big companies will sometimes retain this risk, but they have a lot of these providers on retainer anyways. They're already paying millions of dollars to have some of these providers on retainer outside of the insurance. I would say for anyone else, that's not, the juice really isn't worth the squeeze there. It's worth having the product.
So this product has become a fast way for companies to lose money by underwriting it, frankly. The loss ratio is what, 30, 40%? So every time they write a policy, they've been losing money. And that's been going up. Do you have the exact stat? I don't know. I think we're painting the picture anyway.
Yeah, I think, we saw a bit of a peak during the pandemic. 2020 was a particularly bad year. Cyber insurance prior to 2020 was priced quite low, actually. It was a bit of a soft market. 2020 caught a lot of insurers by surprise with just the number of activity, the amount of activity we saw. And everyone having to work from home overnight, no one really did that securely the first day. We couldn't. We had to do it over the course of a weekend. None of those remote desktop protocols were configured securely. So there was just so many claims that happened in that first year. And yeah, the loss ratios in that first year were 400, 500% for Canadian cyber insurers. London had similar loss ratios. So for every dollar they brought in, they were paying out 4 or 5. And then 2021, 2022, we kind of saw that correction. The price of insurance worldwide went up about 185% in 2 years there. And I think now we're actually seeing a stabilization. I think insurers have mapped this out. They understand what the severity looks like. They understand what the frequency looks like. It's kind of stayed where it was in 2020, which we can underwrite to and we can understand. So it's a better time now than it has been in the last 2 years. There's been a lot of hurt in the last 2 years buying the product.
And where it's gotten is anybody in the room that's done a cyber application or tried to acquire cyber insurance over the last few years, you're recognizing it's like other lines of coverage. It's getting more detailed. It's getting more stringent on what you need to do in order for them to cover you. And really what that is doing, just by applying for it, is making your company understand where you're lacking, how easy it would be for somebody to come and have a cyber attack with you. But even just going through the application, and then when they underwrite you, not only are they giving you some form of checklist of what to do to apply, but then they're actually ethically hacking you and helping you button up things as well, because as Mark's going to talk about, the insurer, the company, Intact, Coalition, CFC, whoever, does not want you to have claims. They want to help educate you around running your business without interruption and protecting your power profitability there. Threw that in there for you, Don. But with that, maybe we will use that. Or did you have one last item?
Yeah, if we just pull up the next slide really quick,
Yep.
actually, I think this is a good point for this room specifically. So what this slide is touching to is just which regions in the world is it, effectively the worst place to have a data breach. I think Scott Moe did a really good job earlier today talking about the globalization of agriculture and the technology that we face nowadays, as well as just Saskatchewan is a bit of a global hub for this. I mean, especially in the manufacturing space, your suppliers, your vendors, your customers are all over the world. That U.S. export number was 90% of the members here are exporting to the U.S., 80% to other countries. So, on top of Canada being a bit of a hub for cybercrime, we have one of the highest costs of data breaches worldwide. The U.S. leads this by quite a bit. So there is a real risk here, I think, to people in the room that we do live in a globalized space, and these U.S. claims are starting to trickle into Canada significantly more, where we're seeing kind of conduits. So your vendors, your suppliers are often the conduits into your own networks. It might be your German supplier, your German vendor is also the conduit into your networks, or vice versa.
Yeah.
So these claims can get quite complex.
We'll show the next slide too, because I think it rolls in just to kind of, you can see, is it industrial about halfway through is showing the trend of the average cost of a total data breach.
Yeah. So once again, I mean, just kind of what I think this slide shows really well actually is the fact that it's critical industries. You know, these criminals are fairly nuanced. They're fairly smart in the sense that they understand that critical industries cannot have downtime like other industries can. Meaning that when they have encrypted data for a critical industry, the clock is ticking. They know that for healthcare, 48 hours down could mean that, you know, someone dies in hospital potentially. In 2020, we saw our first ransomware death in Germany where the hospital was actually encrypted. And these criminals will say they don't do things like that. They will come out and say that that was a mistake of ours, or we don't do that, or, you know, we don't hack healthcare. But the stats tend to tell you a vastly different story. They're going after critical industries. These actors are going after critical industries. And I mean, agriculture is as critical as it gets. It's right up there with healthcare. It's right up there with, you know, feeding the world. You know, industrials being kind of seventh there, that captures both manufacturing as well as a lot of the agricultural work that gets done. So.
And we can bring it right to this room. I mean, it was Donna who actually told me about a story where a paint booth ended up becoming a part of the cyber hack in a manufacturer space, and all of a sudden it was overworked and overloaded on purpose to the point it started on fire. So, I mean, that ended up kind of being something where you're looking at a property claim, but, you know, cyber threat that led to it. So with that, want to welcome Mark. Mark's a director with Intact. Many of you in the room, I wouldn't be surprised, are either with him or have been or considering. So the reason we thought it was important to bring Mark in is that we wanted to give you a chance to hear, other than just from a broker, how does Intact view our industry? What is Intact looking at? And why are things continuing to go up when it comes to property insurance, right? That's a question that I get from clients all the time. So maybe we'll start, Mark, with explaining how Intact or a market, whether it's Intact or just in general, sees a client. You look around at the business owners. How are you looking for them, and how is that relationship bridged with a broker? How do you see that from your point of view?
Yeah, absolutely. Yeah, thanks for having me. I'm happy to be kind of the main representative from the insurance company side of things. We've got a lot of we've got a lot of clients in the ag manufacturing space as well as other industries too, but a lot of what we're talking about today is really applicable to this room. There's no doubt about that. We do work through brokers. So I've been in this role for 23 years or so in the commercial lines underwriting space. So our teams, we decide and we review with our broker, you know, what coverages are needed for each individual account. We really focus on that mid to large commercial space. So we're actually creating solutions and insurance coverages that meet the needs of each individual. It's not a flower shop or a shoe store that, you know, kind of can take a package off the shelf and that covers their needs. So, but that three-way partnership with the broker is critical. So the more information that you share with your broker, that the broker can share with us, data is king. You know, as every industry, the insurance industry relies on data. We are using it more and more. Intact's the largest insurer in Canada. We have a lot of data, and we use a lot of advanced ways to analyze that data. What Wes was saying about cyber, where we saw, you know, prices starting low, people paying out 4 or 5 times the premiums they were taking in. That's obviously not sustainable for the insurance industry in that cyber line of business. And then massive correction of, you know, doubling, tripling of premiums for that line of coverage, while at the same time increasing the number of restrictions and exclusions. So the good news is we have a lot more property data. We've been doing this for many years. Creates more stability and it creates more solutions for sure. But yeah, that three-way partnership with the broker is really important that way. The broker really creates competition for you from multiple insurance companies. The more information you provide them, the more competition they could create. We have a few macro things that we're concerned about from a property standpoint. But I kind of feel when I got invited here and I saw who else is on the panel and the topics, I was like, well, there's a lot of aha moments that can happen with cyber. It's like the new cutting edge thing. There's D&O, which again, people are kind of learning about, but you're all probably sitting there and saying, I've insured my building for 40 years. I know I need to insure my building. What are you doing here? But really, things are changing. So your building that you've insured for 20 or 40 years, like, you think of the equipment that you've had in that building over the time. Everything's much more computerized, so much more, susceptible to smoke damage or water damage compared to the mechanical machinery that used to be in there 30 years ago. It's just the amount of plastics, the amount of flammables. I love that you already mentioned a paint booth. That's where we see all our fires, and they're not usually caused by a cyber attack, but that's where fires come from. So those things, the chemicals used in those have changed over the years too, and inflation. That's one of the biggest things. If you want to throw up that slide there, Dustin, on inflation of building costs, that one there. So that black line would be non-residential building costs and how that's changed over the past. So basically, since in 2021, your costs are about 20% higher than they were in 2017. And then in 2023, the cost to rebuild something is 40% higher than it was in 2017. So we've all seen inflation everywhere in our lives, everywhere in our businesses. And what that really means is, and that impacts our industry. So the same claim, the same damaged piece of equipment, or the same portion of a building that may have had fire damage or smoke damage, that costs us more. Costs us more in labor, costs us more in materials to replace, as well as your professional fees. So I think there's a few accountants and lawyers in the room that got some really, really great suits on. Those fees are up higher, there's no doubt about that. And that's warranted, right? Everyone's input costs are going up, everyone's service costs are going up. So that impacts the costs of our claims.
Yeah. I want to jump in because I want to take a moment and make insurance real for you, because in January, I get a call on a Saturday at noonish, and I see it's a client that I don't typically would get a call on the weekend from. And I answer, and I just want to paint the picture, and then I'm going to pull Mark into this. It's, hey, it's me. I've had a fire, and everything is gone. The police have just left. The firefighters have just left. You were my next call. Everything is gone. We're talking about, I think it was about an 18,000 square foot shop. It's January. Everything was moved inside. So all of a sudden we go, do I have enough? Do I have enough? And he's on the phone, and I'm sitting literally just finishing stuff with my kids. And I go, okay, I'm going to have to call you back. But how this laid out, the next day comes into the office with his wife. And, I'm looking at somebody who might be the average age of this room right now. And he's staring me. I'm staring him. His wife's beside him. And he is asking, do I have enough? Are we covered? Where are we at on this? And to see if I could just tell you how gut-wrenching it is to not have confidence if you have enough, if your employees can maintain their jobs. Many of you are rural. You are the community. And our job is to be with you to restore lives. The business name, we just saw so many business names slide across the screen, 30, 50, 40, whatever years. That's great. But why you are here is for your people and your community. And I just wanted to paint that for you so that when your broker is reaching out 3 months ahead of renewal, would like to know something, and you kind of fan it off, think about this guy. I'm telling you, it's hard to not get emotional. He ended up being okay. Things are going to be all right. But he didn't have the confidence he wanted in that moment. And you got to ask yourself right now if you're comfortable or confident. Been renewing it. But as Mark just said, that is significant change since the pandemic. And the biggest thing I'd tell you is get a third-party valuation of your property, because it's not up to you to necessarily know the rebuild cost and the debris removal when you're just trying to run your business, right? And a lot of times people go, well, I could sell it for $1 million. That means nothing to your insurance broker. What matters to your broker is, what do you want to rebuild this if it goes down? And what else is in there? And in today's dollars, at the time of loss, your insurance policy is a living, breathing thing. You should treat your business and insurance policy almost kind of the same. Oh, wow, we just added another CNC. That's $1 million too. Hey, Dustin, we just added this. It's getting installed. Can we add it to the policy now? If you're waiting for your renewal, you are the one exposed. So lessons from the loss is where we're going to loop back to Mark, because we learned a lot of things, and I want to share that with you on things you could do right now so that if you are the one that phones your broker and go, do I have enough? You have a little better answer. So the one thing that we discovered was after it was all gone, it's pretty hard to remember what was there. You have operations people in your companies that walk around with a smartphone all the time. How often have they ever pulled out their smartphone just to video your stock and inventory and machines on an average day and keep it somewhere, send it to your broker? We all spend a lot of money on technology to be able to back up. But maybe you can speak to that, Mark. What are some examples of lessons learned from claims?
Yeah, no, that's a really good point to bring up when we're talking about inflation. Appraisals are extremely important. We as someone who receives a submission from a broker, if it has an appraisal, that is something we really review. It also helps you understand what bylaws might be applicable too. Like maybe you can't rebuild exactly the way it was today. Maybe you have to add, upgraded sprinkler design or whatever it is. The Premier was talking about how there's been so much growth. I'd say each individual company, many of you have seen a lot of growth. So maybe you've expanded your operations. Business interruption is really important that we're finding. So you're talking about underinsurance on the building itself, but this is ensuring your profits, making sure your cash flow, making sure you could meet your financial commitments to others that you work with, your payroll as well. So we've seen an uptick in ordinary payroll coverage. So it's some people either think it's already covered or don't think you can do it, but essentially you're able to, if you're down for 8 months because you're rebuilding your building or getting a new machine installed and it's the microchips are backlogged and we can't have that supply chain coming through quick enough, you're able to still pay your employees during that time.
And back to the people, what's the point of rebuilding if you've lost all your staff?
There's such a shortage of skilled labor right now.
Exactly.
If after 6-8 months you got to hire new people at higher salaries, because we know that's how it works, and also train them, so you're not up and running nearly as fast as we could retain those
Common
people that were
trend
there.
is when we used to, before the pandemic, see 12-month indemnity for business interruption. Almost everybody, and if you haven't, write this down, check on your policy. Am I at 12 months or am I at 24? Because this will pay until you are back to actually achieving where you were at the time of the loss. Yeah. So not just, I can build my building, okay, but you've maybe lost customers. They had to go somewhere else. How long do you need to get back to profitability?
Mm-hmm. Yeah, that's key things to look at. And if you're insuring your ordinary payroll and you're paying your employees while you're down, think of the engagement, think of the loyalty you're getting. Like these people are going to appreciate that and they're going to stick with you. They're not going to go to some other competitor who's offering, 10% more or something like that. So there's so many business benefits to having that assessment done, and then you can decide if it makes sense from a cost benefit perspective. I think, well, anything else? Oh, you asked about loss examples. So yeah, videoing your equipment's really good. Even like storing backups on the programs for your CNC machines, like putting that in the cloud, putting that offsite backups, like making sure that when the physical item is repaired, you are up and running as soon as possible. Those are some tips that I've heard of. And then again, when you're expanding or changing operations, is your loss prevention system still in place? And that's really about the potential of a large claim versus a small claim. So you expand your production, your spray booth was fine, in 5 years ago when it was installed, but now you're doing a lot more through there. So maybe it's not up to code. It's grandfathered. You're not doing anything illegal, but that's something that those appraisals can help with bylaws reviews, but then also getting your local authorities to inspect as on an annual basis too.
Yeah, and let's talk about, you're hearing us talk about adding, which means more money. And I'm looking at Core, and he's looking at me being like, when we asked you to come, we wanted to talk about saving money on insurance, not spending more. So maybe we'll talk to Mark about efficiencies in how you are insuring. Because adding more, but not thinking about your business with your broker and getting best value, that's what we're really about here. Okay, so there's a difference when we're talking about this group that is doing $100 million in revenue, and this group that's growing and doing $5 million, in how you should think about self-insurance, right? So maybe we can talk about strategy from the expert here, Mark. I'm thinking, around the deductibles, risk management, proactively, those types of things, but you can speak to that.
Yeah, absolutely. We have seen an increase in co-insurance penalties. So as a result of not having adequate insurance and you have a total claim, some of that is not
I'm going to
insured.
jump in because it is a 50-50 chance when I meet with people, they know what a co-insurance penalty is. And I'm going to give a real easy example. You've been insuring the building for 20 years at $1.5 million. And at the time of the loss, it was actually $3 million to replace. Mark personally does this. No, I'm just kidding. He takes the calculations of what you did insure, which was $1.5 million, divided by 3 million. You're at 50% of what you should have been. What happens?
That's how much you get of the loss. 50% is covered, 50% would be retained by you. So it's basically an inadvertent deductible that gets applied. Because what we do is we set our capacities, we set our pricing based on insuring the full value of a building. If you only insure half of the building, then that's not how we've determined the adequate pricing to make our profit, but then also make sure that we have enough money in our bank to cover should there be that claim. But no, that's a good point to clarify for sure.
Yeah, and so you get half, and then all of a sudden your D&O starts to trickle in because you can't reopen because you've just ran out of money, right? Because you don't have access to the funds to replace. Higher deductibles, you're going to hear that when I talk to you is like, well, is your deductible the same as it was 5 years ago? Chances are the best way to keep your cost of risk down is not making claims. And I know I get guys that look at me and go, so I'm buying it to not use it. I go, ideally, there's a difference between having a really bad night and you lose your license versus somebody's dead on the road. Dead on the road's when you want insurance. Losing your license, you got to self-assess. Okay, would I make a claim at that? And I know that's a bad analogy, but it's a real one you can think about. If you start to take the attitude that your insurance policy is really about being able to be viable again after any loss, and you can take a deductible. We have many clients that over the last couple of years have went from $1,000 to $2,500 to $5,000 to $10,000 to $20,000, and they've been trying to do that because they're recognizing we don't want to make that small claim. We can educate our team in advance to not have this come up, and we're going to get the cost savings of the policy. So you might be able to speak to that.
Yeah, we give a lot of options. So a lot of the times when we're working on a renewal, a broker or a new risk to us, a broker is asking for deductible options. And I think that's a really smart thing to do. Like, don't ask for 73 deductible options, but figure out what your risk tolerance is. I was speaking with someone last night, and they said, yeah, we had a $30,000 fire, not a big deal, the size of their operation, that wasn't game changing. They were able to get up and running very quickly. I don't know what their deductible is on their policy offhand, but I hope their deductible is around that level, because if they're comfortable doing that, they should be getting the premium discount associated with that. So if they have a $5,000 deductible on their policy, but their comfort level is and their cash flow allows for a $30,000 claim without too much aggravation, they should be at a $25,000 or $30,000 deductible to make sure they're not paying more for the insurance. So that's one way to make it more efficient. And back to the inflation comments, like if you were at $1,000 deductible 10 years ago, you know, what are you buying with $1,000 deductible or with $1,000 today, right? Much less than you were back then. So,
And the spin-off from this also goes to, now that my deductible is up to 20, I'm not insuring any of my equipment under 40. I'm not making as many small claims. Guys like Mark are going to go, I want this company because their claims frequency is low. They have a high understanding of insurance because they're taking on some risk themselves. They're less likely to make claims. They haven't made claims. We can give our best rate possible to this group.
yeah, I would say one thing that's quite consistent with how we view manufacturing risks from a property standpoint is it is a severity-prone class. We expect large claims. I have a great example not too far from here. There was a guy, employee working on a spray paint booth. He well-trained, good operations, good procedures in place. He did not bond the gun to the drum, and he has done it 100 times. He did have that bonding cable that was there. He didn't do it, and a fire ensued. It was a $13 million claim. That's what we're here to pay. Like, we're fine with that. That everything was done right there. But we want to make sure people are using insurance not as a maintenance policy. You know, you do your preventative maintenance and you spend that money there, so then you have less insurance costs because you can have less small claims, but you still have that protection to remain in business, to keep paying your employees, to keep paying your suppliers, keep your profits stable, cash flow stable when a big event like that happens.
Yeah, and
I think just to tack onto this, I think some of that retention strategy conversation should be quite analytical. I mean, I think a lot of C-suite here has a rule of thumb in their head of what would be a life-changing claim for them, whether that's $50,000, $100,000. But there's also, I mean, your broker should be able to help you with that calculation and should be able to look at your balance sheet and say, this type of claim shouldn't have a material impact on cash flow. Therefore, across your entire program, reducing your total cost of risk, this is what we should be looking at with deductibles across every policy, right? I mean, ideally, you're not having claims on multiple policies in the same year, but that also has to factor into the conversation of what if that happens, how much are we retaining in 1 year in order to kind of reduce that total cost of risk, right? I think your maintenance budget should also be put into that number as that's just a cost of risk number, right, alongside insurance.
what some brokerages are starting to offer, I know we do, is bring around an expert on loss prevention ahead of time. It can be something done every couple of years, maybe in line with when you're doing your appraisals, and getting advice on where have we seen claims. And I know Intact is a great partner in doing that for their clients. These are the top 5 spots we've seen. Let us check these on your building. And maybe there's a little bit of a cost to ensue to go ahead and put up that barrier or do this upgrade. But the whole idea is keep you running, doing what you do best, right? So we're getting closer to getting through. You guys have done great. You guys make me believe you care about insurance, and that's very nice. But Mark, maybe from a national level, Intact level, where is it going for this group? We want to look ahead. I know that we're talking, the conversation has been how nice fall's been, right? Oh, global warming, in Saskatchewan. But weather trends, catastrophic losses, we've read about Hawaii, we read about Kelowna. Maybe you were unfortunately involved even closer than that. How is that all playing into Intact at maybe a bigger level that could trickle down into this room and something they can be kind of thinking about?
Yeah, so catastrophe losses driven by weather, we call them CATs because cats are way cuter than saying catastrophe all the time and easier to put memes together on. But we have found that the trend has been going on. We're getting more of these CAT-type claims. So a CAT is a weather event that impacts multiple lines of business, multiple policyholders, multiple properties. This isn't new. The trend has been going on for 10 years plus. You can see on the map there, it's across Canada. So in the past, we would see, okay, what are the major events that have happened across Canada? And we would say, 2016 was the Fort McMurray wildfires. Everyone remembers that. The biggest one in record for many, many years before 2016 Fort McMurray was the 1998 ice storm in Quebec. For those in the insurance industry, that's a big deal. And that was, inflation adjusted, that was the biggest claims year ever. But now what we're finding is an increased frequency of events, and they're not quite as big as those big events, but they add up more at the end of each year. So since 2018, every single year has been in the top 10 years of insured losses due to weather.
Say that one more time.
I'm going to say that again. So basically, if you say which years had the highest amount of insured losses, the top 10 years, every year since 2018 falls in that top 10. And already in Q3 of 2024, 2023, it will also fall into that top 10. So, yeah, that's a trend that's real. It's not going away. It's climate change. We're trying to adapt, and we are adapting again through data, through analytics. It can be bad news. It can be doomsday news, but we've adapted already as an insurance industry, and we're going to keep adapting. So we adapt through more data, better flood modeling, better wildfire modeling, so we can pick and choose where we're going to have our capacities. Maybe it changes deductibles, maybe it puts in sublimits, and then other markets could come in to write excess. So there's a lot of options through many different insurance, both domestic and in London, that can help continue to provide coverage, but it can and will increase prices. How it impacts us as an insurer. So we talked about inflation. So that means customers need more. Customers need more limit. So we've got to make sure we have capacity to provide those limits. We actually buy reinsurance on a lot of that stuff. So reinsurance is insurance for insurance companies. So just like how we will take a big loss from someone at that table and we will spread it amongst all our customers at all the tables, a reinsurance company will take a catastrophic loss from one insurer and spread it around the globe to make sure it stabilizes everyone's finances. So though the cost of that goes up, many would have seen large increases in their premiums probably over the last couple of years. I won't ask for a raise of hands. But in January, most companies renew their treaties which is basically an agreement for our reinsurance. And it's an annual agreement. And they went up 25% for us. So our insurance costs went up 25%. Plus, we had higher deductibles that we took. So now the next ones in January are expecting to not go up that much. Things seem to be stabilizing. We seem to be getting ahead of where we need to be with all this change of climate and whatnot. But the good news is there is more competition that seems to be coming in. More capital is flowing into both reinsurance and insurance companies. So with that, I think rates are more stabilized. We'll see. I would say some people will be experiencing some rate reductions. Some people will still experience pretty much a same renewal as before. Some will experience higher. And it's again, how does a broker work with you to create competition on your account? Whether it's through preventative maintenance, whether it's through, what can you do? You're not going to change the weather. You're not going to change what happens there. But understanding, like, are you in a flood zone? Ask your broker. They can get that information from an insurer. And different insurers have different maps, and we all use multiple data of information, so there could be options out there. If everyone will be subject, no matter wherever your building is in Canada, it's an isolated thunderstorm that will hit you at some point. These heavy deluge of rain, so making sure your flat roofs, the drains are cleared out. It's what you can do is what's in your ability. Don't sit and worry about, is the carbon tax going to actually help or not? Like that's irrelevant to us, right? We got to protect our assets where it makes sense. So. But yeah, I think there's good news. There's more stabilization that's coming through the marketplace. And like we said with cyber, you get more data on stuff. We're getting more data on climate. We're getting like wildfire mapping is becoming a lot more possible, I would say. Same with hail mapping, a lot more accurate. So it allows us to make sure we're providing capacity everywhere. It might look different in some zones versus other zones. I think Saskatchewan's sitting in a pretty good spot compared to earthquake issues that there are in BC and hurricane issues that there are on the Atlantic coast, and even the hail that we get in Alberta. So I think Saskatchewan and Manitoba are in a good spot. You're not immune to it. Everyone's got to kind of be impacted by this, but I'd say they'd be less here than a lot of other parts in the country.
So when I hear all the last 10 years are the biggest losses ever, yet he's able to say we are still seeing some rates start to stabilize and come down through a pandemic that we've, navigated with uncertainty. And I think that is good news. It's very nice that the insurance company side has been very responsible to stay in the game. And you in this room are not necessarily the industry that every market wants to write. And I'm going to tell Mark straight up, we've been trying to create competition for our clients. And I talk to different insurance companies like Intact, and they go, we love ag manufacturing, but we need it to be, not so isolated. Like and I go, well, then you're telling me two things, because the reason that ag manufacturing is so big in the prairies and across Canada, I recognize it's a national conference, but here we are in Saskatchewan, is because, I grew up on a farm. My dad made a Frankenstein swather himself, and, you'll read a bit in my bio about how I grew up with a welding machine and a metal press and all this, and that's why I'm so honored to be with you right now and why this is a part of my niche. But we're trying to tell the message on your behalf to the Intacts, which they are great. They are supporting many of you. But there's others out there that when they see that you are in, Frontier, St. Brew, smaller centers, they love the industry, but they don't like where you are. Well, they got to fix that, because the reason that the evolution of manufacturing is in the middle of quote unquote nowhere, I grew up there, so don't take offense, is the whole no one was coming to save you. So you had to manufacture it yourself, and then you started to help your neighbor. And we're starting to get some buy-in from other markets other than Intact to really actually take a bite into this, because you have done such a great job of growing your industry and being a profitable industry for insurance companies, because you are doing the right things to not have major claims that could have been prevented. So that's the good news, is that more are coming to play. And so that means, as nice as Mark is to come from Calgary, he's also given Apple Watch for us to raffle off at the HK Henderson booth in the trade show. But we are doing our best to drive competition for Intact to have to answer to the bell for you in the room. To, just like these SciAS guys, I wonder if they'll come back and say, cut insurance costs. That's the way that we're going to be more profitable. But with that, I know that we're about 5 minutes from our time. I didn't know if there was any questions from the group. I wanted to allow time for that. If there was anybody brave enough, there is some microphones. If anybody wants to even raise their hand, we would take a question. Go ahead. Did you hear the question?
Yeah, I did hear the question.
I'll just say it, because sometimes I'm at these and I can't hear the question, and I only hear the answer. I think he's asking about artificial intelligence being implemented more into the manufacturing industry. Will that impact cyber events?
Yes. That's the simplest answer. I think as much as industry adopts artificial intelligence, with OpenAI just being the best, most well-known example of it, I mean, there's thousands of these algorithms and these models out there. Industry adopts it. The criminals have also adopted it. And what we see more often than not is the criminals are often further ahead than industry is in adopting things like this. So it's much easier to spit out a new strain of ransomware using something like an OpenAI that can write code for you. Obviously, OpenAI they don't do that. They make sure that their algorithm will not do that. But it doesn't mean there's not other algorithms out there. There's not ones built by these other actors that won't build you a new strain of ransomware immediately, and can do that at a moment's notice. So yes, I also think AI is the way to also innovate our way out of this, though. I think it's just an arms race. It's like anything else. I mean, the more we spend on cybersecurity, we're still dwarfed by how much the criminals make off cybercrime. Globally, it's about 1/3 of what we spend on cybersecurity. The criminals make 3 times that. It's effectively the 3rd largest economy on the planet, cybercrime, right behind the U.S. and China. They makes about $6 trillion a year. So,
we got another question. If you want, you can say your name and your company. Free advertising.
Sure. Rob Syke, Visor Pro AI.
nice.
It's not the reason I'm actually up here, but I wanted to bounce off. I have an executive assistant named Shelley, and I was infiltrated. Our communication, they tapped between me and Shelley, they tapped into our email. And so they would send an email to Shelley as if it was me, and Shelley would respond back to me. They would catch it, respond back to Shelley. So one day, Shelley gets an email from me, not me, saying to pay a $30,000 consulting bill in Vancouver. Shelley emails back to me, they catch it. She says, where do I code this? I, not me, send back to Shelley, code it to professional services. Money starts leaving my account, and Shelley goes to me, not me, she goes, we can only send out $5,000 a day out of this account. I, not I, respond back, well, just send out $5,000 a day until we pay off the $30,000. Me, real me, look in my bank account, $5,000 to leave in my bank account every day. And I'm going to Shelley, I call her, what's this for? She says, it's for you. You said to pay this bill. I said, for what? For professional services. I say, I have no idea what you're talking about, Shelley. So she screen captures, sent it to me. We got to the bank, we involved the RCMP officers, tracked down the bank account in Nova Scotia. It was a bank in Nova Scotia in Eastern Canada, but I lost $5,000. I couldn't get all of it back. So this stuff is happening around us, probably more than you realize, and some code words or whatever are pretty important. So that's my story. It only cost me $5,000. That's all.
Just to weigh in, I mean, that is a very typical thing, I think. Yeah, that's an awesome story. Thank you for telling it. The surprising thing, I think, for me of that story is that they deposited the money in Scotiabank, or the Bank of Nova Scotia. That's not the norm. So, I mean, luckily in your case, the RCMP actually has jurisdiction over a Canadian bank. More often than not, that money will go to Hong Kong, it'll go to China, it'll go to Russia, where the RCMP can see exactly where it goes, but they have no jurisdiction over it. So, I mean, it's a great story. It's very lucky that you were also able to retrieve those funds. And I'm sure those stories happen, like you said, daily. They happen to everyone. But yeah, usually they are offshore quicker than normal. I think these criminals as well, the average time they spend in your network prior to doing something like this is 277 days. So they would have been aware of the relationship between you and Shelley. Just understanding what that back and forth looks like, and making it, being able to write emails in your voice, in her voice. That's just because they've been sitting around probably for quite a while and seeing how the company operates. And so when they actually do something, it works.
Well,
yeah.
and to Wes's point, we were having a advisor meeting internally and said to Steve, who's in the room, said, if you want to sell a cyber policy, get somebody's attention, ask them, what would you pay personally to make sure that every text message that you've sent, every website you've been to personally for the last 277 days was not made public at a time you really didn't want that to go public? It puts it in perspective a bit. So, on that joyful note, a couple of last thoughts. Again, we're here through the duration. Our panelists will be exiting. Wes is around and tomorrow, but Mark and Danielle are getting back to their family. Please grab them at lunch if you'd like to ask anything. We touched on only the surface of items that we go over with our clients, but we wanted to give you what we believe was as much relevancy to your room as possible. Little tips. Understand your general liability limit and understand Canadian dollars versus American dollars. I was just talking with John at Near Alta about that. I was saying, hey, where are your sales? Go to your broker. Find out, I'm making more American sales next year. We can tell you how much that American sale costs versus a Canadian sale per thousand on your liability, and hopefully we can help you stay profitable with the cost of insurance because you bake it into your overhead if possible. Obviously, you got to be competitive, but where are you doing business? Tell your broker. That's why they ask, where are your revenues next year? Where are they going to be and how much? Then they can go to Mark and say, hey, Mark, like, what's this cost? And so we help you try to pay for the cost of being a real business and doing the right things in terms of protecting your business and your people. Also, last thing, don't let others' contract of doing business with them determine for you what liability limit you are carrying for your business. Does that make sense? Don't just say, I have $2 million limit, because that's what I'm required. Ask yourself more questions with your trusted advisors around what could happen if we ended up having multiple claims in the same year? How much limit do I actually need? And what am I self-insuring versus what am I just kind of doing that's contractually obligated? And so my last slide, I think it got added. Maybe it didn't. I should have checked. But what we do in a risk workshop is ultimately we want to understand what is your strategic risk, your next 3 to 5 year plan. What's your business risk? What's going on in your business right now? Then let's just leave hazard risk to the side, because that's more the traditional triangle that you are used to hearing from your broker about. Okay, here's a statement of values. How much stock? How many buildings? How much equipment? What's your profits? Okay, here you go. What we're trying to do to change the cost of risk for your room is understand your business to a point we can advocate to the Marks of the world and tell your story, put your value out and negotiate, create competition, and that's how we start to drive costs down and build up a backup broker or backup market for you as well. Then, how do we save you money is prevention strategy, helping you understand ways to prevent, like we talked around the risk assessments ahead of time. Mitigate, having a video, for example, of your stock. Okay, we made a loss. We knew there was a loss, but the loss wasn't as big as it could have been. A quick farm example on mitigate, because I love this one. Anybody who grew up on a farm knows that at the end of a harvest day, you act like, my dad was not the kind of guy who was like the photographer, but at the end of every day, you line up all the combines and then the grain cart, then the grain trucks, and it looks like it's a postcard, right, of your farm every night. That is not a very good mitigation strategy, right? As an example of all of a sudden, lightning strike, fire, and your postcard, hopefully you took a picture, right? So that's a mitigation strategy. Transfer, all about contract review. Those types of services are available to help your business grow and maintain, protect your power, and move into the future. After that, then we get into the more elementary side of things, which is, okay, what's your deductible? What do you want to assume? But through this exercise, your broker should be helping you uncover unknown potential black swan events that could erode your profitability, and you deal with them proactively and understand what is covered by Mark and what isn't. So I just wanted to leave you with that as a strategy, and hopefully you guys all got a chance to take 1 or 2 things back to your office and recognize that we're partners in our clients' profitability, and protecting power is what we were about today. So thank you very much for the opportunity.